Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Let's begin by looking at some key signs that could indicate a CEO's decisions and leadership style might be harming shareholder value. Understanding these signs is important for investors, board members, and anyone interested in how leadership impacts a company's performance. Over the next few slides, we'll explore these indicators and discuss what they mean for the overall health and future of a business. When shareholders see weak returns, the usual explanation points to external factors like an economic slowdown, rising inflation, aggressive competitors, tighter regulations, or changing demand. While these factors do have an impact, they often don't fully explain the difference between what a business could earn and what it actually earned. More often than not, the real cause lies inside the company: capital misallocation. This is not just a finance issue, but a leadership one. A CEO can spend a lot of time and look visionary or busy, growing revenue through innovation, acquisitions, or other initiatives, yet still destroy shareholder value. The key metrics to focus on aren't just revenue numbers, but returns on capital, free cash flow, and whether the company's return on invested capital exceeds its cost of capital. This presentation will provide a practical framework to evaluate whether a CEO, especially a founder transitioning to scaling the business, is creating or destroying value. You'll learn how to analyze financials and behaviors, identify warning signs, and apply step-by-step methods to assess leadership decisions, supported by real examples and a clear summary of pros and cons for this approach. This framework is designed to protect shareholder value, not to judge CEOs personally. By spotting signs of value destruction early, companies can avoid long-term harm like margin erosion from bad growth or wasting resources on projects with poor returns. It also helps reduce strategic confusion caused by constant reorganizations or shifts, and supports better governance and decision-making without slowing things down. Improving free cash flow through this approach can safeguard liquidity and financing options, which is especially crucial when a company transitions from a founder-led to a scaled business, reducing risks of failures or forced exits. Most importantly, it moves the discussion from subjective opinions about strategy to objective economic questions, whether the strategy generates more value than it costs. This shift helps maintain focus on what really matters, creating and preserving shareholder wealth. A CEO who is truly ready to scale focuses on improving three key financial outcomes consistently: the return on invested capital compared to the cost of that capital, ensuring that the business generates more value than it costs to fund it; the durability of free cash flow, meaning that as the company grows, its ability to generate cash only gets stronger; and maintaining reinvestment discipline, where any new investments earn returns at least as high as the existing business. You can think about this with a simple equation for creating shareholder value. It's growth multiplied by the difference between ROIC and WACC, then multiplied by reinvestment discipline. If a company is growing fast, but the return on capital is declining, that's really just growing value destruction. To keep a clear view on this, track core metrics like ROIC, margins, both operating and gross, free cash flow margin, how much cash is tied up in inventory and receivables, the unit economics per customer or order, and most importantly, the incremental returns from new investments. While a CEO may tell a compelling story, these metrics reveal the real truth about their ability to create value at scale. When a company's revenue is growing, but the return on invested capital is falling, that's a clear warning sign. It often shows up financially as slower profit growth compared to the investments made, especially when there's big spending on capital projects or acquisitions without clear payback. You'll also notice rising assets like inventory and receivables that don't match profit increases. On the behavioral side, CEOs may focus more on talking about scale and market share rather than actual profitability. They might resist exiting low return segments, often giving strategic reasons that don't hold up, and make repeated promises about next quarter's performance. This approach damages value because growth only benefits shareholders if the return on capital exceeds the cost of that capital. If returns fall below the weighted average cost of capital, then every unit of growth actually destroys shareholder value rather than creating it. When companies' margins drop and don't recover, it often signals a permanent increase in costs rather than a temporary investment. You'll see SG&A expenses growing faster than revenue over multiple periods, and costs initially described as one-time investments becoming ongoing. Customer acquisition costs also rise without any improvement in customer lifetime value, showing that spending isn't creating sustainable returns. Behaviorally, a CEO might downplay these recurring costs by calling them temporary or fail to set clear milestones to justify investments. Teams may also treat hiring more people as a sign of growth rather than focusing on efficiency. The danger here is that expanding into lower margins and higher fixed costs raises operating leverage in the wrong way. Instead of building resilience, it makes the company more fragile and vulnerable to shocks, ultimately destroying shareholder value. Sometimes CEOs focus on growing by acquiring other companies, believing it will boost returns. But if these acquisitions don't deliver real synergies or improve performance, it can signal trouble. Financially, you might see frequent deals touted as strategic fits, yet the expected cost savings never happen, integration expenses linger, and intangible assets like goodwill swell, only to be written down later. Return on invested capital after mergers often drops below pre-merger levels. Behaviorally, these CEOs tend to enjoy making deals, but lose interest in the tough work of integrating the companies. They tend to dismiss cultural clashes as mere growing pains and support acquisitions with persuasive stories rather than solid numbers. While mergers can create value, they only do so when the combined business earns more than the cost of the capital invested. Many CEOs, however, end up buying growth that actually dilutes shareholder returns. When you see a CEO constantly changing strategy, reorganizing departments, and introducing new priorities without follow-through, it's a serious red flag. Financially, this shows up as restructuring charges every year, projects that start and stop repeatedly under different names, and capital expenditures tied to initiatives that never get completed. You'll also notice employee turnover rising and productivity dropping because the team becomes worn out and confused. Behaviorally, this CEO shifts priorities every quarter, treating transformation like a staged event rather than delivering real results. They tend to blame the teams responsible for execution rather than owning the strategic inconsistency. This kind of ongoing strategic churn doesn't just waste money, it creates sunk costs and organizational fatigue, which ultimately destroys shareholder value. When you see gross margins shrinking and discounts rising, it's a clear financial warning sign. If price increases consistently fall behind competitors or inflation, and sales incentives focus only on volume instead of contribution, that's another red flag. On the behavioral side, when the company culture adopts the belief that prices simply can't be raised and pricing decisions are handed off without clear controls, it sets a dangerous precedent. Also, if the CEO frequently approves special deals for important accounts without strict guidelines, the company is likely losing its pricing discipline. Ultimately, if a CEO can't defend pricing, it means they're operating a commodity business, whether they acknowledge it or not, undermining shareholder value in the process. One of the key ways CEOs can unintentionally destroy shareholder value is through poor working capital discipline, which acts as a hidden cash drain. Financially, this often shows up as increasing receivables, meaning it takes longer to collect payments, inventories piling up, and payables shrinking because the company isn't negotiating favorable terms with suppliers. You might see profits reported, but the cash doesn't actually come through. Behaviorally, this is reflected when CEOs focus on income statements rather than cash flows, display overconfidence in sales forecasts, hoping issues will resolve next quarter, and lack accountability for aging stock and collections. The impact is significant because working capital is real cash that keeps the business running. When discipline here is weak, companies end up increasing debt, diluting equity, or underinvesting in critical areas, all of which ultimately erode shareholder value. Underinvestment in core capabilities often starts with cutting R&D or maintenance spending too sharply, which might look good on short-term earnings but leads to problems down the line. You'll see customer churn increase and service costs rise later on. Quality starts to slip, causing more returns and warranty claims. Meanwhile, competitors keep innovating or serving customers better. On the behavior side, the CEO might treat these important investments as optional expenses, often saying we'll fix it later. Cost cuts become a constant theme, celebrated as a strategy rather than a temporary fix. The real damage here is subtle and happens slowly. It starves the company's competitive moat, causing value to erode over time, even if the numbers look okay at first. Recognizing both the financial warning signs and the CEO's attitudes helps spot this danger early. Founder control problems often become clear during the transition from startup to scale up. You might see high executive turnover or key roles staying vacant too long because the CEO is too involved in every decision and approval. This creates bottlenecks that slow down product launches, pricing adjustments, hiring, and customer responses. Behaviorally, CEOs who can't delegate outcomes and only delegate tasks often promote loyalists rather than the most competent operators. The company's brand might revolve too much around the founder themselves, showing an I am the product mindset. Ultimately, this limits growth since the company's potential becomes tied to the CEO's personal capacity, which goes against the idea of scalability. When you see these signs together, in both numbers and behaviors, you have a strong indication that founder control is damaging shareholder value. When CEOs focus more on manipulating key performance indicators and managing appearances, rather than addressing the substance of business issues, it creates clear warning signs. Financially, this might look like adjusted EBITDA being highlighted as a positive while actual cash flow weakens, frequent shifts in how performance is reported, aggressive capitalization of costs to inflate profits, or a large difference between reported earnings and free cash flow without a clear reason. Behaviorally, these CEOs spend more time crafting the narrative than improving systems, discourage dissent within the organization, and replace real operational fixes with promises to communicate better. Our managing optics can temporarily delay accountability. It cannot generate real cash. And ultimately, shareholder value will follow the true financial health of the company. Recognizing both the numeric signals and leadership behaviors together provides the strongest indication that value is being destroyed. When a CEO ignores risk, it puts the whole company in a dangerous position. You might see rising debt levels without the cash flow to support it, or the company relying too much on a single customer, supplier, or market. Problems with insurance, compliance, or audits can also be red flags. On the behavioral side, a CEO who dismisses concerns about risk as negativity, fails to plan for emergencies, or views resilience as just an unnecessary cost rather than a way to protect the business's cash flow is creating serious fragility. This lack of risk awareness can lead to major setbacks that permanently damage shareholder value. The combination of risky financial indicators and these dismissive behaviors signals a fragile operation vulnerable to catastrophic loss. To evaluate if a founder is ready to scale, start by building a value creation scoreboard that tracks key financial trends over 8 to 12 quarters. Focus on revenue growth, operating margin trends, and returns such as ROI. Also monitor free cash flow and cash flow margins, working capital metrics like days sales outstanding, inventory on hand, and days payable outstanding, as well as capital expenditure intensity. If available, include customer churn and retention rates. Lastly, track incremental margin to see the profit added per unit of growth. It's important to interpret these signals carefully. For example, if revenue is rising, but returns on invested capital and free cash flow remain flat or decline, this suggests issues with leadership decisions rather than market conditions. This framework helps separate the real drivers of value creation and readiness for scaling. The next step is to clearly distinguish between reported profit and economic profit. First, consider the cost of capital for the business. This is the minimum return investors expect. Then look at whether the return on invested capital or ROI stays consistently above that cost. It's also important to see how incremental ROI performs on new projects, markets, or products. A founder who is ready to scale understands these returns deeply and can confidently defend them. This focus on true economic profit rather than just accounting profit helps reveal the real value being created and ensures growth is sustainable. Start by looking at every major investment made in the past 2 years and dividing them into 4 groups: core growth projects with high confidence returns, capability building efforts that improve things like technology or productivity, speculative bets that have uncertain outcomes, and maintenance activities that simply keep things running. For each investment, ask what the expected return was, what checkpoints or milestones were set, and critically, whether the projects were stopped when the assumptions proved wrong. It's important to recognize that CEOs who destroy value often fail to kill off bad projects. Instead, they may disguise them under new names. This audit helps to reveal whether capital is being allocated wisely and effectively toward real value creation. Look carefully at how the company sets discounts across different customer segments and whether exceptions to pricing require proper approvals. Check contract terms too, especially anything related to pricing adjustments like indexation or escalation clauses, and whether customers commit to minimum purchase volumes. It's also important to understand the sales incentives in place. Are they motivating margin growth or just volume? A founder ready to scale treats pricing strategically, using clear discipline rather than making it a one-off negotiation. They view pricing as a system that supports long-term value creation, not just short-term deal-making. To ensure a founder is ready to scale, it's critical to stress test the business model with various what-if scenarios. Imagine demand dropping by 10 to 15%, input costs rising by 5 to 10%, higher interest rates or financing costs, or losing a major customer or key supplier. After running these scenarios, evaluate how quickly the CEO can cut costs without impairing core capabilities and how resilient the cash flow remains. A CEO who proactively builds this kind of resilience is protecting shareholder value and preparing the business to withstand downturns effectively. This step is about understanding risk and the organization's ability to adapt under pressure. A founder who is ready to scale shows several key behaviors. They delegate decision rights but maintain clear accountability, ensuring responsibilities are well defined. They bring in experienced professionals in areas like operations, finance, and sales as needed, adding the right oversight without losing control. Instead of constantly responding to crises, they establish a regular rhythm for managing the business, which creates stability and predictability. They are also willing to stop investing in vanity projects or low-return segments that don't contribute to growth. Importantly, there is a clear connection between their strategy and the unit economics of the business, meaning that the financial model supports their growth plans. If a founder keeps managing the company as if it's still a startup when it's time to scale, the business risks destroying value much faster. This step helps us understand if the founder's approach aligns with the demands of scaling and sustaining growth. It's important to recognize patterns that are common across industries rather than focusing on individual leaders. For instance, many tech companies have pursued rapid customer growth before proving their unit economics, and when funding shrinks, those lacking pricing power or retention end up needing to cut staff and shift strategies abruptly. This shows that growth without profitability becomes a serious risk in tougher times. Another well-known example comes from retail, where rapid store openings in less profitable locations can boost revenue temporarily, but ultimately reduce returns due to issues like cannibalization and operational complexity. Strong leaders know when to pause expansion and focus on improving yields instead. In mergers and acquisitions, some companies grow by buying others but fail to invest in integrating them properly. This may increase reported earnings initially, but mismatches in culture and operational friction gradually erode margins. Acquisitions only create real value when integration is handled effectively. Finally, cutting costs by reducing customer support may improve margins short term, but often increases churn and lowers customer lifetime value, forcing higher marketing spend and leaving margins worse off in the long run. Cost cuts without a clear view of customer economics often cause more harm than good. These examples highlight important lessons for scaling businesses with an economic profit mindset. This framework offers several key benefits. It provides an objective, finance-driven way to diagnose performance, shifting discussions away from personalities and toward measurable results. It acts like an early warning system, catching signs of value loss before they become permanent issues. By improving governance without getting into micromanagement, it allows boards and leadership teams to concentrate on returns and maintaining discipline. It also helps different teams like sales, operations, and finance to communicate in a common language focused on cash flow and returns. Lastly, it supports better CEO development by helping founders adopt the behaviors and routines needed to effectively manage and scale their business. One thing to keep in mind is that data quality can be a real challenge with this framework, especially when trying to calculate ROI and CTS accurately. So it's best to start simple and build from there. If the framework is used too rigidly, it might discourage smart long-term investments, since necessary capability building could be unfairly penalized. There's also a risk of focusing too much on short-term returns, when some strategic moves might temporarily lower returns but create strong advantages in the future. So judgment is important. Some leaders might resist this approach because it shifts focus from narrative-driven leadership to strict economic accountability. Finally, remember that not all value drivers are immediately quantifiable. Things like brand strength, talent growth, and platform investments take time to show results. So it's helpful to use milestone gates to track progress over time. Most problems with shareholder value come from within the company rather than the market. What really matters isn't how charismatic or confident leadership seems, or even how bold their strategy is. Instead, it's whether their decisions lead to real economic profit, meaning returns on invested capital that beat the cost of that capital. It also shows in steady improvements in free cash flow and careful reinvestment that yields strong incremental returns. A founder who's ready to scale moves beyond relying on gut instinct and starts using systems to execute consistently. They build pricing power, maintain cash discipline, and understand when to slow down or stop unproductive growth. To protect shareholder value, the focus needs to shift from whether the CEO is inspiring to whether the strategy actually delivers results and justifies the investment. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.